Let me bring on board Feroze Azeez, who's the Deputy CEO at Anand Rati Private Wealth, joining in this morning. Great to have you on the show as usual. Feroze, how are you feeling? The kind of rally that we saw yesterday, do you think it has more legs, given the fact that, the political uncertainty is out of the way, at least in the short term?
Yes, good morning, Nanta. Yeah, we're feeling good, of course. Feeling good because at Anand Rati Wealth, we've been equity heavy for the last 3 years, and that's paid off beautifully. And we were small cap heavy for the full calendar year, starting on 3rd of January. So, of course, feel happy when you see portfolios they've done well. Point one. Point two, of course, how long will the celebration last, which is the more important question. I personally think if you look at medium term as well, elections have been an opportunity. Last 5 general elections clearly throw up a minimum 1 year return, plus or minus 6, plus and minus 6 months. Minimum return has been positive 10%, even in a 1 year investing period, which is which is a very short term for an equity investor from a long term standpoint. All 5 elections have given an average of 16% return, and none have been negative. So election has generally been a positive trigger, but the perception is negative. Point one. Point two, from a long-term trend standpoint, the broader market is getting a lot of inflows from FIIs, which I think is a paradigm shift FIIs are behaving with respect to India. 5 years back, FIIs would play the India story by participating in Nifty 50, at best Nifty Next 50. Now, when you look at, there are 195 stocks more in the MSCI small cap domestic India index than the Nifty small cap 250. So those 195 extra stocks, if you look at the FII holding there, how is it shaped up, will give you a great test to the hypothesis that FII wants to play the India story, not just with the large stocks. And if this hypothesis is true, then you're looking at reasonable, robust valuations for the broader markets in general. Of course, there are pockets of huge overvaluation. There are stocks. There are about 160 stocks in NSE 500, which are greater than 50p. There are 34 stocks in NSE 500 greater than 100p. So in pockets, there is super overvaluation, especially the 100p ones seem a little irrational. But still in India, you can always spot a 15-20% growth story for the next 5-10 years in the broader market, and FII seems to be playing that. So net, to your pointed question, will the party last? The answer is yes. Short term, can there be some small little pullbacks with a short covering like this? October 26th, when it was the last expiry, the shorts of FIIs in the index futures was 84%, and anything more than 80 always reverses. I have seen over the last 7 instances in the last 2.5 years. So now today, if you stand today, you're looking at 61% shorts and 39% longs, which is still not exaggerated on the other side. So there is some more juice left, even in the short term. But if you look at the synthetics, weekly synthetics yesterday were huge indication of a short covering. They were quoting at a 50 rupee premium. A 4-day synthetic quoting at a 50 rupee premium when the intrinsic value is 10 rupees is a clear indication of there being a short covering. But the last 15 minutes told a different story, which is today's story, which is a little more muted than what it was yesterday.
Right, that's an interesting point you made, Feroze, that FIIs are now playing the India story via mid-caps. A lot of experts that I spoke to have said that the next leg of the rally will be a catch-up play for large caps, right? But would you concur with that? Because large caps, some of them have underperformed, right? And yesterday we saw the Nifty Bank also make a great comeback, 1600-point rally coming in on the Nifty Bank index. So private banks, do you think there's still a lot of catch-up to do? And secondly, what is the big risk now? Because we have already climbed the wall of worry. Like, you have the war situation playing out. You have high interest rates. All these issues have been climbed pretty decently by our markets, right? So going forward, do you think being underinvested is a bigger risk, or valuation, high valuation will emerge as a bigger risk for investors?
Yes, Nanda, in my opinion, we generally, when we speak of index level valuations, we oversimplify stuff. There are about 11 stocks in Nifty greater than 50p, 3 stocks in Nifty greater than 100. And there are stocks like the banking stocks are not so overvalued when you look at PE as one of the measures, which is not the most cogent method, but I'm still saying that's the popular method, is why I'm using it in our interview. But having said which, I personally think Nifty rally has been normal. Of course, the small cap was catching up. So a catch up does not follow by another catch up. Small cap on 3rd of January this year had underperformed 4.87% compounded for the last 5 years. So small cap was actually doing the catch up. Now, if we supersede that with the Nifty again catching up, then small cap again needs to catch up. Then it becomes a vicious circle of catching up. So point I'm trying to make is Nifty is reasonably valued. The biggest risk, like coming to the second point, which you raised, is earnings not happening. And we very closely track Nifty earnings as they come up. And 944, which is our estimate for this financial year, seems very, very likely and can have some degree of upper side positives of 10, 12 rupees. But the next year's earnings, which is 1076, which is our estimate, that's the risk. If the 1076 doesn't happen and if it just lands up at 1000, then you will see some pullbacks. The markets actually in India being robust is on the back of earnings. If people believe it is for anything else, to my mind, 60-70% of our outperformance is largely attributed to earnings. So if that's the reason for outperformance, the reason for underperformance is also going to be that if there is a negative surprise. So 1076 is what we are eyeing. This year is done beautifully, and 944 on the back of 819 is a reasonable growth. Even if you discount the Axis buying back one-time loss of one-time write-off of buying the city consumer business, we were at 840. 840 becoming 940 is healthy for a year like this.
Right. So going forward, you said that earnings is something that it decides whether a sector performs or not. So FMCG, for that matter, earnings weren't all that great in the second quarter. We saw a disappointment when it comes to volume growth, right? But now, since the focus will shift to boosting rural demand and spending in the run-up to the election, do you think this is one pocket, where investors should look at? Because manufacturing as a theme has already run up quite a bit. If you look at the cap goods space, infrastructure space, defense for that matter, PSUs, all of them have run up quite a bit. So do you still see valuation comfort when it comes to these pockets, or do you think, consumption is one basket where investors can now look at?
Yes, how we look at it is exaggerations are opportunities. If markets generally have this tendency of exaggerating on both the sides, when they go on one side, they really exaggerate and overvalue them and like a pendulum. So that's what gives us opportunity. FMCG, of course, is not done too well. If you look at the fiscal deficit penetration of the country in the first 7 months, it's just 45%, whereas the long-term average by 7 months, we should have already penetrated the fiscal deficit target by 73.7%. That's the long-term average. So government has been very fiscally prudent. Rural demand will pick up once this fiscal deficit is utilized, and especially before the general election, I'm sure there's going to be a lot of infrastructure spending. Once the rural demand picks up, I think definitely, there could be a reasonable volume growth as well. But having said which, FMCG, especially the large stocks, have penetrated into the corners and the corners of India. So penetration of the distribution network does not become one large source of volume growth. What becomes is only the spending pattern or the increase in consumption is the only leg or the only lever of growth. Volume growth I'm speaking about. So I think FMCG definitely a turnaround expected, and that's largely because the fiscal prudence impacts rural expenditure, and that's why FMCGs are where they are, and that's not very difficult to predict if you understand the cause and effect relationship of each sector. And I think that will turn around, to answer your pointed question.
Right. And lastly, do you think it's time to increase allocation to SIPs? What would you advise investors there?
See, I think SIPs should be a DNA for an Indian. Of course, 17,000 crores of SIP number coming in for the month of October. If you look at October 2021, the number was somewhere around 10,000 crores. October 2021 to October 2023, market did nothing. It was at 18,500 back then. October 2023, expiry closed at 18,858. So point I'm trying to make is, in a period of 2 years of market not doing anything, if retail is participating, this is a huge paradigm shift in the thought process of retail. Retail used to change performance in the past. Now retail is not so performance driven. He or she, as a retail investor, is education driven, because 2013, say, SEBI has mandated a lot of expenditure on education. So I think the SIP numbers are here to stay, point one, and that will become 25,000 crores in the next 2 years. That's the estimate, and that's been an estimate 3 years back as well. So I stick to that. Again, by March 2025, thereabouts, you'll be at 25,000 crore SIP number. Second, should it be a part of every professional's DNA? The answer is yes, because you're committing your future savings. You're not committing your existing savings. A professional 27, 28 crore EPFO accounts in India implies that these guys are getting a recurring cash flow. If they're getting a recurring cash flow and they have a recurring expenditure, so why should not investment be a recurring number? If there are 27 crore EPFO accounts, why should we stick at 4 crore equity allocation? Equity, only 4 crore individuals investing in equity mutual funds, including the SIP number. Indian households have lesser money in equity mutual funds than in currency. If you look at the number, Indian households have 670 lakh crores of household savings, give or take, because this is consolidated data from several websites, especially the RBI website. So if we have lesser money in equity mutual funds than in currency as a country, I think we have a long way to go. All the talk of financialization has just moved the financial savings by 1% in 10 years. If we don't change that by 10% in the next 10 years, then I think we would have missed out.
Right, Feroze, I wish you could continue with the conversation. It's an interesting one, but we are running out of time. I look forward to touching base with you sometime soon. Thanks a lot for taking out time and joining in this morning and sharing your thoughts with us.